All right, good afternoon, everybody. We'll get started. I know we're standing between you and cocktails, so we'll get the ball rolling. Thank you so much for joining us this afternoon. My name is Amy Kiskala. I am Director of Wealth Strategy at Annex Wealth Management. I am joined by my colleague, Brian Lamborn. He's a Senior Wealth Strategist. And in our job there, we work with clients, many of them business owners, doing some comprehensive planning around their estate planning, business succession planning. And Brian, it's your first time here, right?
Yes.
Yeah. So I've had the pleasure of coming to this event for the last couple of years, and I always love coming to it because I love hearing the stories. It always reminds me that there's so much that goes into running a family business, transitioning a family business, and there's a lot of different ways to have a really successful journey. Also means that there's a lot of ways that you can have pitfalls pop up. So that's what we thought we would talk about between the two of us. We've spent many years around financial services in different roles, private practice, consulting. So we're going to share some of the pitfalls that we've seen over the years and with some suggestions about how to maybe structure the planning to hopefully avoid those pitfalls.
So, little disclaimer. Can you guys hear me in back? Okay. I don't like microphones that much, so I'm just going to talk really loud. Disclaimer, this is not legal advice, so on and so forth. So I want to talk about that Amy mentioned just now. We've been around this stuff for a while. I did appreciate, and I just told Amy this, that we just watched people who have done it right. You know, the people who lined up and they did all these pieces, they put it in order, or they're working on it right now. But doing this for a long time, you see a lot of people who don't bother. They ask the question, do I need a lawyer to help me with this, for example? That's usually a bad question. That usually means they are about to do something that they definitely need a lawyer for. And so we're going to talk about a couple of those things today. I mean, we're going to keep it, moving along, but we're going to start with the most important part, which is understanding what you need. I'm going to let...
Okay, sure. Yeah. So really kind of we think about, we're going to talk about planning as beginning with the end in mind. Okay, so what do we mean by that? And the beginning at the end means thinking about all the different ways you can use your wealth, either during your life or at your death. Because there's really only like 4 ways you're going to use your wealth, right? You're going to spend it for your lifestyle. You're going to leave your legacy. You'll leave it to your loved ones. You are going to leave it to philanthropy. You're going to leave it to charities. Or your 4th bucket is the government, right? You can leave them their money in the form of taxes. And so when we talk about the goal of beginning with the end in mind is thinking about what is important to you in each of those categories. And then as business owners, think about, well, how is my business going to help me achieve those goals, whether during my life or at my death? And so I don't want us to walk by the importance of thinking about that lifestyle bucket. So we think about one of the pitfalls that we have seen is that business owners don't start that process of thinking about post-transition lifestyle early enough. So Jane talked about that you got a 5-year runway of working side by side with your CEO and being very thoughtful about it. Also important to put that thoughtfulness around what lifestyle would look like. And part of that is understanding, well, what do you need to support that lifestyle once you no longer have the business? A couple of different components to that, a couple ways to get around what that lifestyle number is. One is you take a look at, well, what am I currently spending? What are my current lifestyle expenses? And I will say the pitfall there is for many business owners, they don't have a good grasp. Some people track their personal expenses closely, but for a business owner, you really kind of are your business. And so we'll have business owners say, well, I only spend about $50,000 a year. And then you lift up the cover and say, well, what's the business paying for you? And let's take that all-in number and figure out what that is. The other way to look at it then is, well, what do I want to live on for my lifestyle post-transition? And that number can be anything, right? It could be $300,000, $500,000, $1 million. But that can be part of that equation as well. That's when once we kind of get an idea of what that number is, then you think about, well, what are the sources of income that we're going to have to maintain that? If it's a sale, when is that money coming in? What's the character of it coming in, and how do we plan for that? If it's that gift transition down to family members, then we have to look at, okay, what are the other sources that might be available to fund our lifestyle. So one of the things that we do very regularly is we actually like put the numbers into a financial plan. Like actually put a plan together and look at cash flow projections. That can be just really helpful in understanding, am I on track? Does that number look good? Or is that number too lofty? Does the plan not really support that? Or maybe there's something in between to say, okay, we know what number we want to get to. Maybe we need to rethink how we're going to get there so that we make sure we support the lifestyle that we want to live.
Right. And so what we're going to talk about today, there are a lot of ways you can dispose of your business. You know, we talk about external, IPOs, acquisitions, internal, sell to your employees, things like that. We're going to focus on a little red circle here. Sale, gift, part sale, and then passing it on to death. So there are a lot of options depending on what you're trying to do. Going back to what Amy just said, what we want to do is start with the lens of what do I need? What do I need going forward? How am I going to support myself? And then we take a look at, okay, how are we going to do that? How are we going to make that fit? So again, we have these options in particular. We have gifts. What does that mean? It means you can transfer the stock of the company to your kids. Very simple. You know, I don't need this anymore. I don't need the income from it. Here you go. Now you get the business. You own it. Doesn't necessarily mean you have to walk away from it, but it also means your kids now own it and can fire you if you decide to stick around. Sales. If you do need the income, for example, let's sell it to the business or to the kids. Okay, I need some income from this business to support my retirement, so I'm going to use the income from the sale to the kids in order to fund that retirement. Next, gift, part sales, kind of self-explanatory. We'll do a little bit of both. And then lastly, you know, if you want to maintain control until you die, you can do that. And so we pass it on, you know, at death. Or we can do parts of estate planning to help manage some of this as well.
All right, so we thought we'd talk about, like, put this kind of plan in action a little bit and talk about a hypothetical family. So we've got Harry and Sally. They have 2 kids. You've got Mike married to Heather. They've got 2 kind of youngish kids over there. You've got Tom. He is divorced. He has more adultish kids, and he's got 1 child, Haley, who is coming into and working into the business. All right, so what is this business we're talking about? It's an S corporation worth approximately $10 million. Harry's currently working there full time, still fully engaged. They also own kind of the land, the building, the facility that houses kind of their operating business.
And so one of the first questions you have is, if I do transfer this business during my lifetime, what is that going to look like? If I sell it to my kids, or, you know, if I gift it, what is that going to look like? What does that mean for me? And so what we're going to start with here is tax rates, because that's, you know, what's going to impact this the most. I want to look at the number on the right side, the far right side, the 600,000 over there. That will come into play. That's the capital gains rate for a married couple. But then you just have the normal ones. This is for 2025. We don't know what 2026 holds for us yet. So this is what it'll look like going forward, and then with some adjustments next year. Next up, we have the gift and estate tax rates, which the tax rate is 40%. For all gifts and all estate taxes. What we have right now is approximately $14 million for each person. So a married couple, it would be about $28 million, 13.99. I just like round numbers, so I round up a little bit. But now coming into 2026, that may change substantially. We have no idea what that's going to look like. Right now, they're talking about it being $15 million, but if no legislation is passed, then it drops back down by half, down to $7.2 million in 2026. So right now we're doing planning as if it's going to drop down in 2026 because, like I said, we don't know what's going on, and any information that we do have is interesting at this point. So
yeah, Brian's referring to the one big beautiful bill, right?
Yeah.
Past the House. We've got, I know everybody's like, one big beautiful bill, that's awesome. But then in the Senate, right, there's some senators who are questioning it. So it does give us a roadmap of what they're thinking about income tax and estate taxes. But Brian's right, there's a long road between now and the end of the year, and there could be some twists and turns.
So first question is, what do income taxes look like if I decide to transfer this during my lifetime? So what we have is Mike is the COO, Tom is the CFO. Harry would like to retire soon, but he and Sally talked to their financial advisor and found out that they don't necessarily have the money that they thought they had in order to maintain their lifestyle during retirement. And so Harry's plan was, okay, I'm going to sell part of the company because I do need that stream of income, or I do need that income. And I'm going to give the other half because we don't need all of it necessarily. So remember, the company's worth $10 million. Mike and Tom would each get 25%. And then, and like I said, the gift would be the remainder of it. What does that mean? That means that Harry would, in this situation, we're going to talk about a lump sum. You know, Tom and Mike went out and got a loan, paid that off in full. He now has $5 million minus taxes, which is where the problem comes in. They bought the stock. The stock is going to be capital gains treatment, adjusted for basis and things like that. So what that means then is that Harry and Sally are going to pay capital gains taxes on $5 million. I'm going to assume no basis because, again, I like easy math. And so what that means is they're going to pay 20%. The highest bracket, that's why I pointed up in the top right corner, the highest bracket for capital gains is 20% over $600,000. Is there a better way to do it? The answer would be yes. Actually, what you could do, rather than sell for a lump sum in the first year, paying taxes on $5 million, what we could do is say, okay, we're going to do this over a period of 10 years. We're going to get $500,000 a year. And now we just brought that number from $5 million in the first year to $500,000 a year, which is under that 20% bracket. So we just lowered their taxes by 5% per year on $500,000, so $25,000 savings. And then we can still gift the rest. But keep in mind, what we're looking for is retirement in this situation. And as we're moving along, we're still getting them their $5 million. We're just doing it slowly over time in a tax-efficient manner. And by the way, this isn't the only solution. This was just one that we're addressing real quickly here. Depending on what people's goals are, we can actually plan for this well ahead of time and make sure that they're meeting all their goals. But this is a nice, easy, simple solution to it. And then another question to this, though, afterwards is, what do we do with the building? Are Harry and Sally going to keep the building? Can they get that revenue from the rent as it goes along? Is that part of the sale? That's stuff that they didn't really think about. They just, sold the company, gifted part of the company. And I will say that I have seen people do this. Like I said, we watch people who have been doing it right. You walk into a business, and I used to be a consultant back in the day, and you walk in and they'd say, oh, I just gifted it all to my kid. No thought process behind it. I just want my kid to have it. And so stuff like this does happen all the time.
All right, let's talk a little bit about where estate planning factors in. So you remember James said, my dad had a really great estate plan, but he did not have a succession plan. So it is with 100% certainty that every business owner will exit at some point, right? We know that to be true. Now, sometimes that exit point is at death, and that might be because that's what they want. I want to hold it until I die, and then I want to pass it along. Sometimes it's because it was a premature death. The death happened before that transition could fully happen. So really important for every business owner to make sure they have an estate plan in place, and make sure that estate plan is also consistent with their business plan. So that is a pitfall that I have seen kind of time and time again over the course of my career, is that those plans are done at different times. Sometimes they're done by different attorneys, and particularly as you start to get to G2, G3, onto G7, the situation starts to look different, and then there becomes a mismatch between what your estate plan says and what those business documents, your shareholder agreement, your operating agreement, your buy-sell agreement might say. Perfect example of that is that it could be, as the generations have passed, mom and dad say, I want to leave this to my kids at our death. I just want to have it as a bequest under our estate plan. But they have this old buy-sell agreement that really contemplated, say, a redemption, or somebody was going to get bought out at death. And so that is something that planning is a continual thing. We like to think we do our estate plan and we're done, but it's something to be revisiting time and time again. And as circumstances change and the generations come in, let's pull out the documents and dust them off and read them and make sure that there's consistency between what your estate plan says and what your business documents say. Now, because in many families you might say, well, family dynamics, everybody kind of knows and understands what the plan is, and so if the documents aren't consistent, maybe, and many times it does work out fine, right, if everybody knows the intent, but people don't argue about documents, they argue about a lot of other things, right? And the inconsistencies in the documents is what can give them sort of that fodder to say, I'm taking this to court because the language of the documents is something different than what we think the intention is. So really important to be reviewing those documents pretty regularly. All right, so first step is to make sure you have the core estate planning documents in place, thinking about what are those documents that have in place that talk about what happens when we die. Two different approaches that you can use there. One is you can have a will, you name a personal representative that administers the estate, where you name a guardian if you have minor children. It can also then say what happens to your property when you die. Now, if you're using a will as your primary document to leave assets at your death, you are saying, I want those assets, generally speaking, to go through probate. Now, most people would say they have a good goal of avoiding probate, and I would say, avoiding probate is a good goal. Also, once life starts to have some complexity to it, like if you have a business interest or real estate, your plan is probably better well suited by using a revocable trust as kind of that key core document as part of your plan. So revocable trust, I set it up during my lifetime. I'm married, so my husband and I can set up a joint trust if we want. During our lifetimes, we are the people that set it up. We're the trustee, the beneficiary. We just kind of going on our lives just like as though we didn't have the trust. We can change that trust at any point if we want. And then when one of us dies, it talks about where the property goes. When the second of us dies, it talks about not only where the property goes, but also who's stepping into the shoes of that successor trustee. So really, that's really kind of a key important part of many people's estate plan. Also wanted to touch a little bit on irrevocable trusts. So an irrevocable trust will have a lot of those same components of the revocable trust. The difference is, though, it's irrevocable. Generally speaking, you can't change it. So those are most typically used not when I'm doing kind of this ongoing planning with my husband, but where I want to, say, make a gift of an asset to somebody, say my children, but I want to put some guardrails around that gift. And lots of reasons why you might want to put guardrails around. One might be for estate tax minimization planning. Often use irrevocable trust in that context. We also put guardrails around just because it's really good planning for our future generations for, say, asset protection. So just had a conversation this morning with somebody and the big D word came up. Divorce. I want to protect these assets in case my children get divorced. Another great use for irrevocable, where you might use irrevocable trust. Now, kind of with all of these vehicles, when you have a business in place, there are some really kind of key fundamental decisions that you need to be thinking about, and when they're not thought through thoroughly enough, that's where you run into the pitfalls. And this has to be, we heard a lot about families where you have some people in the business, some people aren't in the business, and so that key question is, what is our philosophical principle around who can be a shareholder of this company? Is it any family member, whether active or not? Or do we only want to leave shares to the children, the future generations who are active in the business? So many people would say that can be a smoother kind of glide path to keep the business successful, is leave the business to people that are active in it. But then you need to think about, well, what do we do for these beneficiaries who are not in the business? Is the goal to equalize? Meaning, are you going to leave them exact equal dollar amounts? They're just going to get other assets. If so, you got a plan for that. You have to make sure you have enough other assets to equalize. Or you might say, I'm not really concerned about equalization. I'm concerned about fairness, meaning that it's okay if my beneficiaries don't receive assets of equal value, because those kids that are getting that active business, they got a lot of risk there. They got a lot of blood, sweat, and tears that goes into owning that business, and so maybe the other kids get maybe they get a lesser amount. It's different. Cash always looks different than inheriting a business interest. All right, so I have a little kind of twist on this plan. I'm gonna get Mike and Tom working in the business. Now, Mike and Tom, Craig talked about that. He and his brother run different lines, right? Like Mike and Tom they're like even to a greater extent, kind of dysfunctional. They really don't ever get along and don't easily work together. So we've got Harry, he wants to start to reduce his workload, but they know from their plan they need to have some kind of continuing kind of support from the business to kind of hit those lifestyle goals. So Harry says, well, I want to keep 30% now, and I'm going to give away 70% of the operating business to the boys. I'm also going to give them the building, and then I'm going to continue to take a salary for myself. I'm going to reduce my workload, but I'm going to keep taking a salary. All right, so a lot of good things about that plan. It hits a lot of their goals, right? He's got that goal of starting to bring Mike and Tom into the fold of business ownership, but doing it a little bit more slowly rather than just handing them the keys all at once. So they're going to make that slower transition into being an employee to being an owner. So he's given them that glide path to ease into ownership. He's also achieved their goal of having some continuing income stream from the business in the form of salary, but also because he's retained 30%. So he has that ability to take those big distributions out of that. He's also maybe doing some estate tax minimization planning by making that gift to the sons. Now he's going to have to file a gift tax return. It's not going to be gift tax, but he is going to use a portion of that estate tax exemption that Brian showed earlier. Not a bad thing though. So I will say, again, this is going to be a pitfall that we see is when you make a gift and you file a gift tax return, it is important to get valuation. So you're getting a valuation of the business, you're also getting a valuation of the real estate. I will say, Jane kind of said, she said, well, we didn't really want to pay, people don't always want to pay somebody to do that work for them. I once had a colleague who used to say, he was a lawyer as well, he'd say, well, what's good for lawyers is good for America. So retain your lawyers and pay them. So, a little tongue-in-cheek. But the idea is that it's sometimes really important to retain people who do that work for you because it kind of dots your I's and cross your T's in the event that you have an IRS audit. And so I would say, yes, look at getting valuations and think about who's going to get that valuation. So if you can, have your attorney contact your valuation expert and do that work for them. When your attorney does it, there's some work product protection there because there's an art to business valuation. And so some benefits there. All right, so what's the big pitfall here? So the big pitfall here for Harry and Sally goes around decision making. So you've got two kids who are coming into the business and they don't get along, right? So now Harry's stepping away, he's not involved day to day. He has 30%, each of his sons has 35%. Is he creating a situation where there's no longer an efficient way to make decisions because nobody's really in agreement? So it's an important piece to think about. You have ownership and you have decision making. And you really want to think about what that decision making structure is going to look like for Harry because it's an S Corp. We know you can only have one class of stock, but you can have voting and non-voting shares. So one of the planning thoughts for him is maybe he takes voting shares, maybe but non-voting shares, gives away the non-voting share now, keeps the voting, so now he can keep that element of control for a while. And then thinking about, okay, maybe at some point he starts to give them voting shares, or maybe he sets up some mechanism that, maybe the sons are really never the people who are going to be the decision makers, so you can use, say, a trust in that type of example to kind of consolidate the decision making through, say, a special trustee, or a trustee that can actually manage and make those kind of voting decisions. Also really helpful if you have that kind of generations of family where you have active and non-active people owning shares, using some type of mechanism there could be helpful.
All right. Last part is more of the soft aspect of a lot of this stuff. Like we talked a little bit about the technical sides to it, but there is a big question about how will my kids respond to this. In the past, I have seen all sorts of responses. from the parents never bothered to tell the kids what was going on, and so the kids didn't respond because they didn't know, all the way through, you know, the kids just not wanting to be involved, and then finding out later that, you know, the parents had no idea that was the case until everything happened. And so what we're going to talk about here is something like that. So Mike's the chief operating officer. In this situation, Tom doesn't work. He's an architect somewhere else. He's not involved in the business. Harry and Sally found out that they have enough money. They don't need it anymore. Harry wants to be done. He's burnt out. He's, you know, and so his thought process is, hey, let's just move on with this, transfer it to the kids, move to Florida. And so really, their answer was, hey, we're going to gift, and this causes a bunch of problems all at once. But, you know, Harry is going to gift the company to Mike and Tom. Now, what's problematic about that? Well, Mike doesn't want it. And you'll see this in a second, but we'll talk about this more in a second. But Mike doesn't want it, and Tom's not involved. So how does that shake out well for them in the long term, especially if Harry wants this to be a legacy of some kind? And then the other part of his plan is to play more golf, which I can't argue with that. But in this situation, is there something better we can do? The problem is they've never talked. You know, Mike wants a mid-career, you know, a midlife career change, and he never really said that out loud to anybody. But now all of a sudden he has to run a business, which by the way is owned 50% by his brother, who now has a veto, unless they put specific documents in place to manage some of this stuff. And so basically what Harry did is he just threw a grenade in the middle of both of them and said, hey, you guys fix the problem. I don't want to be involved anymore. And so what can we take? You know, the biggest thing we can do in this situation like this, what can we do, is talk. And like I said earlier, I love the panel talking about how, you know, Craig B. talking about, we started this 10 years ago because we realized that there was going to be an issue coming down the road. But there are families who just don't bother talking, don't have any idea what their kids want in the grand scheme of things. And so as a result, you end up in situations like this. So what's going to happen? Probably, you know, Mike and Tom get it. They look around and go, fine, we'll sell it then. You know, whereas, you know, is there another way we could do this? Could we make some gifts perhaps? You know, maybe we gift a little bit to everybody and they each sell their share. You know, can Harry just sell it? And then it'll be part of his estate. He can play more golf in retirement. And so that's one of the biggest things is with a lot of this stuff is communicating your goals, making sure not only that the generation one, whoever's operating at that point knows what they want to do, but you also want to make sure the following generations, you know what they want to do. And this goes back to actually Katie talking about, their structure is immense. The 86 potential shareholders that she was talking about, but they're very specifically targeting saying, okay, this is what certain people can do. We're going to be very clear about what's going on here. And then they set up a mechanism that said, okay, well, if you don't want to do this, you have a way out. And so you don't have to do it to that scale necessarily. It depends on the size of the business. But having those conversations, being very transparent about all this stuff is huge, because you can't fall into a trap of, I don't really want this. I know plenty of people who got to the middle of their careers and decided they didn't want to be, a veterinarian anymore, or you name it, and they want to go do something else. And so as a result, you don't want to pin somebody down with it and say, this is now your responsibility, this is my legacy, please take care of it. Because, at that point, you also have a guilt aspect to it as well. Okay, well, maybe I should continue with this, even though I don't want to, and your plans just went out the window. So that's the biggest part of some of this is communication, whether it's between the first generation, between generations, making sure everybody's on the same page, being very transparent about all this stuff.
All right, so there's a lot of issues to unpack there. We think about kind of creating that roadmap, like what are your action steps, where do you start? It really does start with that idea of prioritization. So we started talking about, well, what do you want for your lifestyle needs? Well, how and when do you envision this transition happening? And so once you start to kind of identify your initial thoughts, it doesn't even have to be fully baked, but just initial thoughts about here's what I think might make sense for me and for the family. If you think about the decision tree that we showed earlier, kind of starts you down the path of a decision tree, which then can help to say, okay, now we kind of know where to start. We can, once you start to bite the apple, then kind of uncovers the other kind of issues. You can start to kind of prioritize, which can just be helpful to get the ball rolling, because that's one of the biggest impediments to getting a plan in place, is just not even knowing where to start, not wanting to think about being so kind of caught up in what business owners do best, which is running their business and growing their business, and that's amazing. But kind of starting to think about that as early as possible, really, really helpful. We can't emphasize enough, I think, the importance of having that baseline financial plan in place. So understanding your numbers, what are your assets? What do you think they're worth today? What do you want for that cash flow to look like through the end of your life and maybe beyond? Having that baseline plan, what that's really helpful for then is that things will change, right? You have this idea of what you think is going to happen down the road. But things will pop up. A child will decide to enter the business or leave the business, and then start to might shift how you think about what that looks like. With a base financial plan, then you can start to run scenarios. Well, what if this factor changes? What if I want to leave earlier than I thought? What if we want to give it away instead of selling it? You can start to see the impact over the long term.
And then one of the biggest ones, and I do appreciate, again, the people who were on stage earlier, assemble your team of advisors. Find people that you trust, find people who know what they're doing. I always say this, I get up here and I talk a lot about, when I do talk, I talk a lot about stuff that you need to go to a lawyer for. I'm not here to sell legal services for everybody. It just happens to be that, you probably need some of these things. And so what you need to do is find somebody who understands what's going on, who has the ability to help guide you through some of this stuff. Have a good accountant, somebody who really knows how these pieces fit together, who can help you file the returns, help you do valuations, for example. Some accounting firms do that as well. And then the last part, as I said, I say this all the time, the biggest part is communicate. People need to talk. You need to talk with everybody about all this stuff, whether that's your kids, whether that's your advisors. And I will say, talking to your advisors is very different from talking to your kids. You're allowed to say stuff to your advisors, and your advisors hopefully won't say that to your kids. But keep that in mind. Like, you do want to talk about these things. Make sure that where you want to go, you have the ability to get there.
All right, so there is a lot on that screen. What this is just a kind of a roadmap of all of the kind of issues to have on your radar screen as you're thinking about running the business, succession planning, transitioning the business. And it is a lot there, and that's the importance of assembling that team of advisors, is that everybody brings a little bit of their own expertise in and can really help you as business owners say, okay, now we've done this kind of initial prioritization, now let's make sense of this chaos. Let's figure out what priorities are, where we need to start, and then how do we kind of set up a roadmap and kind of keep ourselves on the straight and narrow on that path. So that is a lot of the work that Brian and I do every day, is being part of that collaborative team with our wealth managers. Many of my colleagues are here in the room today, so I'm appreciative of them being here as well. But also with the attorneys and the accountants, and just helping you, like we're here for you, to really help you figure out, okay, how do we go about this? How do we keep on track? What are all of these issues, and do we have the right kind of plan in place and the right kind of team around us to help us kind of solve these issues? All right, so with that, we do have a few minutes, so we'd love to hear kind of thoughts, questions, what's on people's minds as you're thinking about all this. Yes, sir.
I think you guys are beating out a major tool to utilize in estate planning that helps both estate planning as well as and business, and is the utilization of an LLC, in that you can transfer the ownership of the business to an LLC, and then you can still retain control of the business and essentially pass off majority interest to the other organization, as well as reduce your estate tax.
Absolutely, yeah. That's one of the tools in the belt, yeah. And, we're trying to keep it relatively narrow today, but yes, absolutely. And that kind of goes to your point is, yes, you can use LLCs, you can use things like limited partnerships. We can use all sorts of tools And one of the things we also didn't talk about was when we're making these gifts, that 35% interest is valuation discounts. Things like that can actually be very powerful tools. You know, something that maybe have a fair market value of $10 million may, for discounting purposes, have a value of $6 million. And so we can use all these tools together in order to kind of move these pieces around into the right place. Actually, that would have been a great one for the real estate, because that's a good place to start, is using an LLC or a limited partnership, and then taking some of those voting or non-voting interests and moving them to the right place.
I have a question. Did you use a holding company to control the estate instead of holding liability on yourself?
What do you think?
Well, as far as like home ownership and estates, as far as families are doing.
Well, so the answer is potentially yes, and it actually goes back. So his question was, can you use a holding company to help manage some of this stuff?
Yeah.
In that situation, the answer is yes. It's kind of what he was referring to as well. You can use like an LLC to manage different levels of stuff. Now, as far as using homes and stuff like that, because you did mention that,
Yeah.
probably don't want to do that. For a house, real estate's a different story. But for your home, something like that, when I hear a holding company, a lot of times I think of corporations that manage a whole bunch of stuff.
Okay.
Don't use corporations for real estate, ever. Like that's a simple tax tip before the day's out. But yeah, so yes, you can use all sorts of entities to do different things in different places, yes. Yep.
I have a question and more or less maybe a pitfall that's on the people side. I'm a recruiter. I work with businesses as they're trying to have the bench to be able to take the time needed to have the conversations and really focus on their long-term plan. I feel like a lot of business owners are so wrapped up in the business they don't give themselves the bandwidth and the space to be able to do the work that you're describing. From your perspective, what's the sweet spot for a timeline to hire, for example, an ops team in a manufacturing environment, so that there's enough of that runway for that leader to be able to separate to make the decisions that you're describing here?
Get a general rule of thumb, like if you have some timeline of a transition, at least 5 years. I mean, at least 5 years would be a good runway. I also think you raised kind of an interesting point around having the right people in place, and that can be difficult in a family dynamic as well, in sort of evaluating the people and thinking about kind of bringing in outside perspective, whether it's a consultant or kind of hiring non-family members, can help kind of bring some of that perspective around evaluating, because that is a really key decision, is who are the right people to bring this to the next level, and do they have the right skill set and training? And that's hard for a parent, and it can be hard for a parent to evaluate when you're talking about your own kids. And so I think kind of bringing in some outside perspective around like that kind of people assessment, and then looking at who are your non-family member key people, and are you putting things in place to make sure that they're incentivized to want to help the business grow and to retain them kind of once that transition helps, because they can be a really key piece of keeping that to generate transfer from, like, say, G3 to G4.
So over the years, what is like something that you learned that you wish you would know like earlier on? Like something for me.
Actually, what's interesting is, so her question was, what have we learned over the years that I wish I would have known earlier? And the interesting part is, it's the biggest thing that I learned is how few people or how few business owners are actually doing a lot of this stuff. I wish I would have realized this many years ago. I would have gotten into the field, this specific field, in a lot sooner, because there's a lot of people who don't have access to, good advisors. I've seen people with, $50 million companies worth $50 million who are still using the same accountant that their dad had, 50 years ago. And so it's, and they never thought differently. And so the biggest thing that I've learned over time is that there is basically a gap a lot of times that business owners don't realize is there. that they may not be getting the best advice. And so the ability to actually talk to people about it like we are today and say, hey, by the way, these are things you really want to look at. You need to be having these conversations, at least as a starting point. I wish I would have learned that many years ago.
And what would be yours?
Yeah, so that's interesting. So I've had a lot of various roles. I've been around financial services. So I started out as an auditor, then I went to law school and was an estate planning attorney in private practice, and I worked in the life insurance industry, and I've been at Annex now for 4 years. And so it's been a really interesting kind of progression for me because I worked in many different things. And I would say what I've learned now, I think is true of a lot of attorneys, and for no other reason than that that's what you're immersed in, is that, as a younger attorney working with families on that, I was very much too much focused on drafting the documents and having kind of all those right key documents in place and really focused on taxes instead of taking the step back and let's focus on the people and the dynamics first. And let's really focus on the personal side. So that's what I really appreciated most about my role at Annex, is that we really work with the accountants and the attorneys, but our main goal is to take care of the business owner. How can we help you make sure you are personally set for the rest of your life and your family is set for the rest of your life? It's going to bring that extra dynamic to it. So the importance of building that wealth outside or alongside the business, I think, is something I wasn't probably as focused on kind of earlier in my career that I am now. I see the benefits of business owners who have, say, that wealth built alongside their business, a lot more flexibility. Decisions become easier when you have something that is built on the number you need to retire is less when you build it up along the way.
Got one?
Yep.
And I'm sure this is greatly case specific, but just want to get your perspective on, let's say there's an S corporation with a succession plan. Non-voting shares have a succession plan or will be gifted or distributed, doesn't matter. But the current or what will be the legacy majority shareholder maintains all voting stock, theoretically in perpetuity, until death, I guess. What is the potential pitfalls of that structure? And again, I know that there's a lot of variables missing there, but or benefits.
Well, I'll say this, a lot of business owners who have substantial companies like control, going back to your question actually, is they can't remove themselves from the control. And so the only pitfall, well, not the only, but one of the pitfalls I can think of is, what are the value of those shares? How big is the company? What does that look like as far as estate taxes go? And the other downside to it, and this could be managed with the board potentially, but is if this person ends up being 100 years old and they still want to control things, is that a good idea? So how can we do things to manage that? And so those would be the two ones that come to mind, just off the top of my head. But as far as, it's only problematic if that, if those kind of issues show up, which, without fail, that's what's going to happen. So, over time. But yeah, I mean, those are the two, like I said, that come to mind. I don't know if you anything else.
No, I think that's it. I think that a lot of it is that next generation prepared?
Yeah.
If control has been with mom and dad for their whole lives, the next generation might have ownership, but they might not have the ownership mentality. And so finding ways to kind of bring them into actual ownership at some point can be really helpful. Right, and with that, we are at 5 o'clock. So thank you so much for sticking around, and I enjoyed